What to make of the stock market's bounce? I'm Bob Stokes with Elliott Wave International. The stock market sell-off from March into the May low was comprised of 8 straight weeks of decline in the Dow Industrials. This was historic. The Dow Industrials have been around for 126 years, and this was only the second time that the senior index suffered a decline for 8 consecutive weeks. The other time was in 1923, also March into May. But getting back to 2022, on Friday, May 20th, which was the last day of the 8th week of decline, our U.S. short-term update said, for certain there will be countertrend rallies as the stock market decline progresses, and some that will be very sharp. Interestingly, after the market close on the last trading day of the following week, a May 27th CNBC article noted, S&P 500 Dow snapped losing streaks for best week since November 2020. The Dow had climbed 6.2% from May 23rd through May 27th, so a significant bounce in a relatively short period of time. Countertrend rallies near the start of a decline or countertrend drops after the first leg of a bull market usually result in many investors believing that the old trend, in this case an uptrend, has returned. For instance, a senior portfolio manager quoted in that May 27th CNBC article said, "We have come a long way down pretty fast, and if we can stabilize here, then the declines we've seen might be all that's needed, or something close to that." In other words, the attitude expressed is that the sell-off may have removed the froth from the market so the uptrend can return. Yet this can be a financially dangerous mindset, as stock market history indicates. Here are 3 charts side by side from a classic Elliott Wave financial forecast. On the left, notice that even the then President of the United States commented that we have now passed the worst after the first big bounce during the 1929-1932 bear market. Of course, much more decline was yet to follow. In the middle and on the right, you'll also notice positive comments following a bounce in the Nikkei's bear market of the early 1990s and during the Nasdaq's drop about 20 years ago. The lesson is that the same patterns of investor psychology tend to repeat over and over. The Elliott Wave model reflects these repetitive patterns. You are encouraged to learn the current message of the Elliott Wave model so you can prepare for what may take the majority by surprise. Just follow the link below this video to get started.